Hello everyone, my name is Lisa Todorella, and today we're going to talk about T-account analysis. But first, before we do that, let's do a quick review over some basics. Okay, so you've seen all of this before. You have three financial statements. There are three formulas for each of those financial statements. For the income statement, you have revenues minus expenses equals net income. From net income, it goes into retained earnings. From retained earnings, it goes into equity. So that leads us to the balance sheet equation, which is equal to assets equals liabilities plus equity. Okay, so here are some key words I want you to identify with these different categories to help you categorize items down the road. When you see anything that sounds like you're doing work, that's revenue. If you see anything that sounds like you use something, think expense. When it sounds like you own something, think assets. When you owe something, that's a liability. And equity, of course, has those two components, which is common stock plus retained earnings. All right, so I want you to stop and think about some items you can own, which will be on the asset side, owe, which are liabilities, and of course, you know the equity categories already. Okay, so I want to draw your attention to two very important items that compare on the assets and liabilities side. First, let's start with assets. So we have accounts receivable or any receivable. That is something you own. Why? Because you're going to get money in the future. Because you did something and the people haven't paid you yet. All right, then you have prepaids. Those are something you own. Why? Because you paid money now, today, and you own that item. For liabilities, you have two main types. You have accounts payable or any type of payable. That is money you're going to owe in the future because you have a responsibility to somebody. You haven't paid it yet. Then you have unearned revenue. That's when somebody pays you as a company today, but you haven't done the thing they paid you for yet. So we get into our T-account analysis. So this is similar to the transaction analysis you did earlier with those pluses and minuses. But the thing is, accountants don't like to think about that in terms. Instead, they like to think in terms of T-accounts. So what is a T-account? Basically, it's what it sounds like. It looks like this little assets T-account on the side here. It's shaped like a T. There's a left side and a right side. The left side is called a debit. The right side is called a credit. So in accounting, there are only two ways accounts can increase, either on the left side, which means you're debiting the account, or on the right side, which means you're crediting the account. So the whole idea is for our debits to equal our credits. So how does this work? Well, assets, let's start with assets. They always increase on the debit side. So I want to contrast this with liabilities. Notice how liabilities are on the opposite side of that equal sign in the equation. So they must increase how? Opposite of liabilities. So they increase on the credit side. Then you have equity that has those two components, common stock and retained earnings. They're also all on the opposite side of the equal sign. So how do you think they increase? They increase on the credit side because they're opposite of assets. The retained earnings had three accounts related to it: revenues, expenses, and dividends. Now, here's an easy way to remember it. Retained earnings and revenues both start with the word R. Therefore, they increase in the same way. So that's on the credit side. Expenses and dividends, those decrease the retained earnings account. So how do you think they're supposed to increase? They increase opposite. But as a quick recap, if you ever forget this, here's the main way you can remember it. Assets, expenses, and dividends are the only three accounts in all of accounting that increase on the debit side. Everything else will increase on the credit side. Okay, so when you have to do this analysis, here are the steps that are involved. First, there are always going to be two items impacted. Remember, debits have to equal credits. So when you read a sentence, identify those two items. Step 2, identify whether those items increased or decreased. Then I want you to think, is this something I own? Is it something I owe? Is it something I did the work for? Is it something I used? And based off that, You can identify if they belong in the asset, liabilities, revenues, or expense category or equity. Then you have to think about whether we debit or credit the account based off those increases or decreases. And then finally, you put entity accounts. And of course, you check yourself. Debits have to equal credits always. And that's the formula if you want a brief recap. All right, here are 3 situations. I want you to pause, solve these on your own, and then come back. Okay, so on January 1st, Sarah, a new shareholder, invested $30,000 in exchange for common stock of Hershey Chocolate Company. All right, so what are the 2 items? You got cash, you got common stock. Okay, did they increase or decrease? Well, both of them increased. So cash, that's something we own. Therefore, it's an asset. When assets increase, how do they increase? On the debit side. So of course, the other thing has to be on the credit side. And there are the T accounts for you to compare those items. Then you have the second event. On January 1st, Hershey Chocolate Company prepaid rent for its factory for 6 years in advance. Yearly rent is $1,800. The total amount prepaid was $10,800. Okay, identify the 2 items first. We got prepaid rent, we got cash. Okay, cash, that's something we own. Oh, first of all, did it increase or decrease? It decreased. We paid for something, okay? And we pay for something in advance. So what's that called? That's something we own, right? So it is an asset. Now that we've identified that, it's very easy. When an asset increases, what do? We debit. When cash and asset decreases, well, it's going to have to decrease on the opposite side of the side it increases on. So that's the credit. Everything's in balance. Debits equal credits. We're happy. 10,800, 10,800. All right. On December 2nd, Hershey Chocolate Company purchased 2,850 of office supplies on account. Okay. So here's my question. We have supplies, right? That's our first account. But was cash involved this time? The answer is no. And the key word is on account. So when we have purchased something as a company and we have not paid the money for it yet, what is that? We owe somebody, right? So when we owe someone something, that's a liability. Okay, so supplies increased. That's something we own. That's an asset. We have a liability that increased. That's something that we owe. And when liabilities increase, that's a credit. And there are the T accounts to support that. All right, keep working through these on your own, and I wish you luck. Enjoy it. Take care.